Okay, let's unpack this. Welcome to the Dup Dive. Today, we're digging into the Agilysys Fiscal 2025 third quarter earnings call. And, if you just glanced at the headlines, you saw this picture with some really bright spots, but also some clear challenges that actually led management to lower their full year expectations. It's a fascinating mix, really. We need to explore it.
Absolutely. Yeah, on the surface, you had some strong record numbers popping up. But the devil, as they say, was in the details, particularly how it impacted their revenue outlook for the whole year. We really need to figure out what drove that complexity.
Exactly. So let's just pull out the top line numbers for the quarter first. Total revenue, it hit a record $69.6 million. That's up almost 15% year over year. And get this, it's their 12th record revenue quarter in a row.
Yeah, quite a streak they've got going there.
Right. And gross profit margin looks solid at 63%, a little bump up from last year. Adjusted income and adjusted EBITDA were also, up nicely compared to the prior year quarter.
Right. The profitability looked pretty good on that adjusted basis. Now, the reported net income, that did show a really dramatic drop year over year. It was down to like $3.8 million from nearly $77 million. But as management clarified, that huge number last year, it was mostly a non-cash thing, some big valuation allowance release. So yeah, the adjusted numbers, they probably give you a better feel for the operational profit this quarter.
Got it. Okay, that makes sense. And the big headline, like we said, was the updated guidance. Management lowered the full fiscal year 2025 total revenue guidance down to $273 million. So you've got record revenue this quarter, but a cut to the full year outlook. That's really the core tension we need to dig into here.
Yeah, let's get into what caused that sort of mixed picture. And it really boils down to different parts of their business performing very, very differently.
Yeah. You can see this most clearly when we start breaking down the revenue components, right? So on one side, you had product revenue. That came in kind of weak, down about 16% year over year to $10.7 million. This segment, it includes things like those older perpetual licenses, hardware sales, that kind of stuff. And it continues to struggle partly because, they're successfully shifting customers to subscription, which is good, but also because POS hardware sales were weaker than they thought. And also the new POS software lets customers buy devices like iPads directly, so that reduces Agilysys' own hardware sales.
Exactly. I mean, that move to subscription, it naturally cannibalizes some of that traditional product revenue, which is, strategic, it's planned. But the unexpected softness in POS hardware and that reduced attach rate for the new POS versions, that definitely hurt this line item more than they anticipated.
Okay, now let's flip that coin. Services revenue, it was up 13.5% to $14.5 million. Sounds pretty good, right?
Yeah.
But management actually said even that came in below their own internal expectations. So what was going on there?
Well, they cited a few reasons. First, they substantially completed a major development phase for a big project, likely the Marriott one we'll talk about, so that reduced the associated services revenue for now. They also saw some customers postpone implementation projects back in December, maybe holiday timing, maybe budget cycles, who knows. And crucially, this seems important, they had difficulty hitting their hiring goals for their implementation teams. And you need those people to get the new software installed quickly.
Right, that hiring challenge seems key, especially because you mentioned the services backlog is actually at a record high. So they have the work lined up, they need the people power to actually do it.
Precisely. Yeah, it suggests the demand is definitely there, but the execution, it's temporarily constrained by just getting enough people on board, resource availability.
Okay, but here's where the story really gets positive recurring revenue. This hit a record $44.4 million. That's up a massive 26.4% year over year.
Huge jump.
Yeah. And management pointed out that's actually the largest absolute dollar increase they've ever had year over year in recurring revenue. And this recurring piece, it now makes up almost 64% of their total revenue. It's the core of the business.
And if you dive even deeper into that, the subscription revenue piece, the really strategic part, that was a record $28.3 million. It soared 45% year over year. Just incredible growth.
Wow.
And this is their sixth quarter in a row with subscription growth clocking in above 29%. Organic subscription growth was also strong, 23%, and they see it trending towards 25% for the full year.
Yeah.
And like you said about recurring, the subscription revenue now makes up nearly 2/3 of their total recurring revenue.
That shift is just dramatic, isn't it? And breaking down that subscription growth even further, POS-related subscription grew close to 20%. That's solid. But the PMS-related subscription revenue, property management systems, that just exploded. It was up 35% year over year, and that's excluding the Book for Time acquisition they did.
Yeah, that's pure organic PMS growth, essentially.
And management specifically pointed out, get this, their PMS subscription growth in just the first 3 quarters of this fiscal year has already surpassed the growth they saw in the entire previous fiscal year.
That really highlights the success they're having with that modernized PMS platform, doesn't it?
Yeah.
It's clearly resonating with customers, driving adoption of their subscription model like crazy in that segment. And, add-on modules are a big part of this story too. They mentioned these now contribute, was it 22% of subscription revenue if you exclude Book for Time, or 34% if you include it? These aren't just tiny features anymore. They're selling them effectively as standalone products now.
Right. So this huge contrast between the, let's say, POS transition challenges and the PMS and subscription success, that seems absolutely central to understanding this quarter. How did that play out in actual sales performance?
It did play out there, for sure. I mean, overall, Q3 was actually their 3rd highest sales quarter ever in terms of annual contract value, just a bit behind Q2. And it was their best ever October to December sales quarter specifically. Plus, overall global sales for the first 9 months, they're actually well ahead of last year's record pace. So momentum overall isn't bad.
Okay, but reflecting that product revenue issue we talked about, POS sales specifically were below expectations in Q3. Better than Q1 apparently, but down from Q2. Management said they expect POS sales to improve, get back to normal levels over the next few quarters. They cited some near-term opportunities they're working on, but they did admit the tech transition from old to new was harder for POS than they expected, particularly impacting managed food services and maybe smaller customers with less IT support.
Right, the complexity of ripping out and replacing older POS systems and maybe the specific needs of certain verticals, that just proved a bigger hurdle than they thought it would be. However, mirroring that subscription success story, Q3 was their best quarter ever for sales of property management systems, PMS, and those related add-on modules. And again, that's even excluding the Book for Time acquisition sales.
Best quarter ever for PMS sales.
Yep. Sales in that category were a staggering 70% higher than the comparable prior year quarter.
70% higher? Wow. And fiscal 2025, they said, is already their best year ever for PMS and related module sales, and there's still 1 quarter left to go.
Yeah, ahead of the previous best full year by 33% already.
It just really underscores it, doesn't it?
Yeah.
While one part of the transformation is proving painful, the other part is clearly absolutely thriving.
It does. And domestically, U.S. sales were strong, including in gaming casinos. They're also starting to see a turnaround, apparently, in that managed food services vertical you mentioned earlier for POS.
What about internationally, APAC and EMEA?
Yeah, those remain disappointing, according to management. Sales levels weren't great, but they are working on some pretty substantial opportunities there. They even floated the idea that Q4 could be a record quarter for international sales. But, they caution it hinges on landing a few large deals, home runs, as they call them, rather than consistent smaller sales, the singles and doubles.
Yeah.
It just takes longer, right? Establishing reputation internationally compared to domestically, where they're well known.
Makes sense. Okay, so sales are a mixed bag regionally and by product, but what about the pipeline? Future deals?
That's another bright spot. The global demo plus sales pipeline, so opportunities that are at the product demonstration stage or later, that's at a record level, it's up 20% compared to the previous year end.
Okay.
And breaking that down, the pipeline specifically for POS is up 22% year over year, despite the recent sales softness. And for PMS, it's even stronger, up 37% year over year. So that suggests, deal momentum is building. The interest is definitely there.
And they're adding new customers too.
Yep. Added 12 new logos in Q3, 11 of them fully subscription-based. And these new customers, interestingly, are signing up for an average of 6 products each. That's a record high attach rate for new customers. Shows the breadth of the platform.
6 products on average for a new customer. Wow.
Yeah. They also added 76 new properties from existing parent companies, so expansion within the base. And they saw strong cross-selling too. Sold over 200 new products into their existing installed base just this quarter. Fiscal 2025 is already their best full year ever for selling new products to existing customers.
So let me recap that. Record pipeline, record new customer product attach rate, best year ever for selling into the base. These all sound like really positive indicators of underlying demand and, the value of their product suite. Even if, as management acknowledged, the overall sales momentum could still improve, along with that installation speed and maybe the total new customer count.
Exactly. Their focus now seems clearly on execution. Getting full territory coverage, expanding the sales team, especially targeting hotels and resorts, and just enabling the current team better.
Okay, let's quickly touch on profitability and cash flow before we move on. Overall gross margin. They expect that to stay just north of 60% for the full year, and maybe expand incrementally, like a point or two into next year, as more of that high-margin subscription revenue comes online. Makes sense.
Yeah, standard sauce leverage story there.
And operating expenses, excluding stock-based comp, as a percentage of revenue actually decreased slightly this quarter compared to last year, down to about 42.1%. Product development and G&A were lower as a percentage, while sales and marketing increased, which also makes sense given the focus on driving sales growth right now.
Right. And the bottom line on adjusted EBITDA was pretty healthy, 21.2% of revenue for the quarter. Profitability, they said, is actually running ahead of their original plan for the year, mainly because some costs are lower, tied to those reduced overall revenue expectations.
Interesting. So the revenue miss is actually helping profitability relative to plan in a way. What about cash?
Now, looking at the balance sheet, they had about $60.8 million in cash and marketable securities at the end of December. Now, that's down from about $145 million at the start of the fiscal year, back in March 2024. But that decrease is largely due to the cash portion they paid for the Book for Time acquisition. They also used a $50 million credit line for that deal.
Okay, so acquisition impact. But are they paying down that debt?
They are, quite quickly, actually. They paid down $12 million of that debt by the end of Q3, and then they paid down another $14 million after the quarter closed, so subsequent to December 31st.
Good progress there. And free cash flow, how's that looking?
Very strong this quarter. Free cash flow was almost $20 million, $19.7 million to be exact. That's way up from $11.3 million in the same quarter last year. And for the first 9 months of the fiscal year, it's $25.9 million, again, much higher than the $10.7 million last year. Management basically pointed to adjusted EBITDA and free cash flow as good proxies for the underlying health of the business right now.
Strong cash generation is definitely a positive sign. Okay, let's shift gears to a really key future catalyst. Everyone watches the big Marriott PMS project. What's the latest there?
Yeah, so the update was that the initial significant development phase is now substantially completed. That's a big milestone.
Okay, so development's mostly done. What's next for that project?
Well, now they're moving into the really rigorous phases of ecosystem and system performance testing, basically making sure everything works together perfectly at scale. And alongside that, deployment planning is kicking into high gear. They expect to start having actual test properties using the system in the second half of calendar 2025. And then pilot property installation should follow in that same kind of time frame, second half calendar 25.
Okay, so testing and pilots starting later this calendar year. How did management sound about it? Confident? Any issues?
They sounded quite positive on the call, actually. Said the project is progressing well, being managed effectively by Marriott, which is key. They highlighted high transparency and good collaboration among all the vendors involved, and importantly, no major scope changes reported. So seems like it's on track from their perspective.
That sounds promising. It's probably worth noting, though, right, that the development services revenue that was associated with this massive project, that's going to drop off significantly now that the main development phase is done.
Exactly. That's a key point. That services revenue stream related to the development work will be much smaller going forward, which in turn will impact their overall services revenue growth rates, probably bringing them back down to more, let's say, normal levels after being elevated by this project work.
Right. So it shifts from a development phase, which brings in services revenue, towards a deployment phase, and then eventually the recurring revenue phase, which is the real long-term goal. But there's that dip in development services revenue in between.
Precisely. It's a natural transition for a project this size.
Okay, so bringing it all together then, that full year guidance cut down to $273 million in total revenue. It seems clearly tied back to those product revenue challenges we discussed. Primarily the disappointing POS sales performance, right?
Yeah, that seems to be the main culprit. They now expect full year product revenue to be down somewhere between 15% and 20% year over year.
Right.
That's a bigger hit than they originally thought they'd take during this transition.
But they still expect subscription growth to be at least 38% for the full year.
Right. Massive growth there continues.
And profitability, as we talked about, is still on track or even slightly ahead of their original plan.
And management was very, very direct about this on the call. They attributed the top line headwinds, that revenue guidance cut, solely to the internal transition pain. Moving from the old technology to the new, specifically the unexpected sales challenges on the POS side. They were adamant it was not due to any external issues, not macroeconomics, not the competitive environment, not any structural market problems. It was all internal execution on the transition.
They sounded very confident then that their underlying business fundamentals are actually stronger than ever.
They did. Yeah, they expressed a lot of confidence there. They talked about operating leverage becoming steadily more effective over the medium and long term, which should support further profitability improvements even while they continue to invest in growth initiatives.
And they also threw out an updated total addressable market size, didn't they? Something much bigger.
Yeah, that was interesting. They cited it now as a huge $16 billion TAM. That's up significantly from their previous estimate, which I think was around $5 billion.
$16 billion. Wow, what changed?
Well, they explained the jump reflects how they're now competing effectively with those add-on modules, not just as attachments, but as standalone products in their own right. So it significantly expands the types of deals and the market segments they can actually go after now. And they pointed out, given their current market share is still relatively low, they mentioned less than 300,000 rooms in a global market of maybe 20 million hotel rooms. They see just vast runway for expansion, both with their core solutions and with all these add-on modules.
Okay. So management's core message seems to be, look, we hit an unexpected kind of sticky pothole in the POS transition. It hurt near-term revenue. But the really important strategic shift to subscription is accelerating even faster. The PMS business is absolutely on fire. The overall pipeline is strong. The market opportunity is way bigger than they thought. The huge Marriott project is on track, and we are confident we'll get past this temporary issue.
That's pretty much their narrative in a nutshell, yeah. They express strong confidence in overcoming this challenging phase. They pointed to their modernized product portfolio now being easier to implement, easier to support, easier to enhance going forward, which should help smooth things out.
Okay. So what does this all mean for you, the listener? It was definitely a quarter of conflicting signals, wasn't it? You had records in some really critical growth areas: total revenue, recurring revenue, subscription revenue. PMS sales were amazing. The pipeline looks great. But that was held back by real, tangible challenges in legacy POS sales and also in services execution, mainly hiring. And those directly caused that cut to the full year revenue outlook.
And management is adamant, just hammering the point home, that the problems are internal transition pains, bumps in the road, not external pressures or fundamental market shifts.
Right. So the core question for anyone looking at the stock now is, well, do you believe management's assertion? Is the POS weakness truly temporary and internal? Or is there potentially something more fundamental going on there that they're maybe underestimating?
That's the judgment call, really.
Okay, so let's step into our This Is Not Financial Advice segment. Let's brainstorm an outrageous but plausible idea based solely on management's conviction and the data they presented. If you do buy into management's story that the POS issue is just a temporary blip, an internal execution fumble that will improve in the coming quarters, and you combine that belief with the frankly undeniable strength and momentum you see in the higher margin PMS and subscription business, plus the record pipeline across both POS and PMS, that significantly expanded $16 billion TAM they're talking about, and the very visible catalyst of the Marriott rollout starting to hit test properties in the second half of calendar 2025.
And don't forget, profitability is actually ahead of plan despite the revenue miss.
Right. Add all that together, you could argue that the market's negative reaction to just the lowered revenue guidance might be an overreaction. Maybe the market focused too much on that short-term POS problem and kind of missed the bigger, more positive picture, this accelerating shift to a much more profitable, predictable, recurring revenue model, plus those significant future growth drivers.
So the trade idea here, potentially quite bold, maybe even outrageous, depending on your risk tolerance, would be to initiate a long position. Go long the stock. You're essentially betting specifically that the POS recovery happens faster or maybe stronger than the market currently expects over the next, say, 2 or 3 quarters. If that happens, if POS sales surprise to the upside on the revenue line, you combine that potential surprise with the continued expected strong subscription growth and maybe some positive news flow or commentary around the Marriott rollout progressing. Then the market could pretty quickly shift its focus away from that temporary POS headwind and start re-rating the stock based on the underlying business momentum, the recurring revenue strength, and that future potential.
And that strong free cash flow they demonstrated in Q3, that provides the company with a nice cushion and flexibility while they work through these internal issues, right?
Definitely adds a layer of safety.
But the thesis, it really hinges entirely on management being correct. Correct that the POS pain is only a temporary transition problem, not some deeper issue with the new product or increased competition they're not seeing yet. And it also hinges on them being able to fix those hiring challenges relatively quickly so they can actually execute on that record services backlog and convert it into revenue.
Yeah, it's basically a bet that their internal fixes will succeed and that the clear momentum they have in other parts of the business will carry the day and re-accelerate growth.
So to wrap it all up, Agilysys delivered, well, a really complex quarter. You had definite strength in those strategic high-growth areas like PMS and subscription revenue, record levels, fantastic growth. But alongside that, a notable unexpected setback in legacy POS sales directly linked to their technology transition, which dragged down the overall revenue expectations for the year and forced that guidance adjustment.
Yeah. So the key things to watch going forward seem pretty clear now. Number one, can they demonstrate a tangible recovery in POS sales momentum over the next few quarters? Number two, can they execute against that record services backlog? Which really means, can they accelerate hiring for those implementation teams? And number three, providing tangible updates on the timing and the progress of that massive Marriott deployment as it moves into testing and pilots later this year.
Exactly. Those seem like the key milestones to track.
Well, thank you for joining us for this deep dive into the Agilysys Q3 Fiscal 2025 earnings call. We hope breaking it down this way was helpful. We'll continue to unpack these kinds of reports for you. We'll plan to catch up again after their next earnings release, which will likely be around mid to late May for their full fiscal year results. Until then, stay informed.